Hello guys, glad to have you on board again today. We have skipped those ones for just a few weeks, obviously extreme conditions with this coronavirus confinement in France and stuff like that. But anyway, today I do have a little bit of time in front of me to record this, and anyway, it was right about time to do it. We had to move a little bit forward in terms of schedule with this one, but it's still the appropriate timing to do so. So let's talk about the stock picking podcast. So first thing you should have noticed is that this is going to be a phase one, because it would be way too much to say into just one podcast, and more than anything else, stock picking is a very complex stuff. We're just going to try to scratch the surface at some point. I might be going fast forward on some technical elements and stuff like that. So don't get me wrong in here, it's not going to be perfect, just trying to make it good enough for you to start with. So phase one, for what reason? It's very simple. It's actually that when we go stock picking, we're talking about investments. So investment is not something that you do just like speculation. These are two very different stuff, even though they have a lot of similarities. So let's call it that way. What could be the similarity between stock picking, though investment, and speculative strategies? Both are pretty much the same thing. I mean, stock picking, though investing, remains speculative in any given way. Obviously, you're taking risks out there. You don't know the outcome. You're just going to try to limit the possibilities for you to be proven wrong and to lose money in the process. You're going to spread the risk, which means when we invest, we certainly don't speak about putting money into one company. We're talking about putting money into multiple companies, spreading the risk out there. So this is what we're going to talking about. How different is the risk management between investing and speculative trading? You do know how speculative trading works. We do work on this every fucking single day. So today is going to be a little bit different. So I'm going to try and telling you how to invest. So it is a very tough topic, just like I said. Just saying it out loud sounds real stupid. So I'm not going to teach you how to invest. I'm just going to teach you the basic of making decent investment strategies. I'm a professional, so I do it personally. Whatever I'm going to be telling you today is something I'm not just saying, I'm totally applying it. So we're talking about real basis fact in here, and that's, I think, important to say. So a lot of people are trying to give away investment courses or whatever shit that is. They're trying to sell it. Obviously, I'm giving it for free. I'm just explaining to you how I do proceed. So before we go any further, this is just my personal method. There are way too many methods. There are just probably as many as there are living traders. The problem is you most likely will end up with scammers out there. So one single rule for this thing: never pay for a course. If you pay, it's probably that it's worth nothing. So here is how I do, and take it for what it is. All right, don't take your information from single sources. So just take whatever I say today as a basis point of introduction, and just focus obviously on having some other persons talking about this subject, just making sure you're not too much biased by my personal vision. Okay, so now that all the introductions is all made, let's get forward with it. What are we going to be talking about today? So the structure of investment. How do we structurize this thing? Why is there 3 steps? How do we deal with 2-day step? And the difference though between speculative investment and strategical, between speculative trading and strategical investment. How much money do we talk about? Can we use leverage? All of those questions, I'm going to try answering all of those things. How do you decide to get into this asset or this asset? I'm trying giving you my tips for this. Is there a perfect stock picking? Certainly no fucking way, just like there is no perfect trade. So there are just as many stock picks as there would be traders and strategies and stuff like that. And even if you follow my guidelines, and even if you follow my strategy for speculative trading, which we're going to use as a basis in here, you're not necessarily going to stock pick the same things that I do. So let's get to start with the actual first right and very important question. What do we fucking buy, and where do we start with? So before you even consider making a stock pick, you need to ask yourself a very, very simple but tricky question. where the fuck do you think are we going to be 5 years to 10 years from now? Because this is the time frame we're talking about. You're just trying to put yourself ahead of the next 5 to 10 years. So investing is not something we do like a speculative trade is going to hold for a few hours, few days, eventually a few weeks at best. And here we're talking about something that's going to surrender. That's not going to be surrendered unless a few months or a few years have passed on by. So it is future forecasting type of thing. The exact same thing I just tell you not to do when we're speculative trading. So in here I'm going to tell you to do right the opposite. Just cool down for a bit. Just close your eyes and try to project yourself 5 to 10 years from now. Try to imagine not yourself but the world. So what do you think about the world in 5 to 10 years? What is what's happening? What are the major changes? What are the stuff like that? Just try to put yourself into that type of projections, all right? Whether you like sci-fi series or whatever that is, just put yourself into this game. Because the actual first and very underwhelmed important first step is have some fucking thoughts, have some fucking ideas. It's important that you think. It's really necessary. It's like sometimes I generally tell you that the step 0 of a trade sequence is generally you having an idea, wanting to do something, and then you get to contextualize this thing, finding favorable context, price filterings, and then signal filtering to just get to somehow optimize this basic first idea. But in here is the same process. If you don't start with an idea, then you're going to get to a very huge problem afterwards, because in here we're talking about holding these trades for years. So if you don't really have deep thoughts and deep thinking and ideas on this thing, then you're likely going to end up with some second thoughts or whatever. So just try to think about it, and you're going to normally try to pick 2, 3, 4 companies. When we do this thing is for a specific purpose. I'm going to explain later on, but doing this thinking process is you should get out of this with 3 or 4 companies, no more than that, all right? We're talking about the big names. We're not talking about sectors in here. I'm talking about a company that you think is going to be building the future 5 to 10 years, all right? So I'm just going to give you my names, but let me be clear in here. If you just try to fucking blindly copy me in here, first of all, you don't really get to profit from this because, like I said, the thinking process is part of the process itself. So if you just blindly follow someone, you're just not getting it right. More than anything else, copying a trader never made anyone profitable in the fucking world. Otherwise, I would have known it by now. All the signal services, all the external and whatever, these things are just most likely bullshit most of the time. So don't blindly follow someone. I'm going to use and be transparent with my personal portfolio exposition, relative percentage allocations and stuff like that. I'm going to tell you everything about it. But what matters in here is not the conclusion, is how I got to get to this conclusion, and what's the process I've been putting in motion, so you can make your own process. All right, it's most likely for inspiration in here. If you do copy trade, then just god damn it. I mean, I can stop you from doing it, but this is really pointless. Anyway, so I personally decided to pick 2 companies specifically, Tesla and Virgin Galactic, just because, all right, this is, I've made this thinking process I was talking about and just trying to project myself in the future. Do I think about autonomous driving and stuff like that? Yes. Do I think there's going to be Teslas all around the streets? No, fuck no. I think that what we might have is Tesla being part of the revolution of autonomous driving, not necessarily selling cars. And what I like in Tesla is not their cars, is the software in there. So do I think this type of software will globalize by the next 5 to 10 years? Yes. So that's a personal belief. You might agree, disagree. We're not here to talk about it. We're not even here to debate on the future of Tesla. I'm just here explaining you my personal assessment on this thing. Whether you agree or disagree, I don't really give a shit. It's just that you must have this same thinking of process. Not just saying, I want to buy this company because I like it. But I want to buy this company because I think it's going to do this and this and this and this and this in the future. Try to make it as rational as possible. The strongest the feeling, not the feeling, the strongest these scenario you're building, the most likely, the stronger you will be in holding this trade. And remember that we're going to need to hold for years. And during those years, you're going to hear some people telling you, but man, you bought Tesla. This thing is just overrated. The stock's going to collapse. And if at that stage, let's say the stock just dropped 20% of your entry price, if someone tells you, man, you really took a very wrong bet in here. I mean, if you're not solid enough into your thinking process, then you're just going to say, all right, maybe he's right. Maybe I shouldn't have gone into this trade. Maybe I should just sell my 20% losses. God damn it, that's not how it works, not even close. So we're going to get to this later on. That's actually the next stage. After you built it yourself some convictions on a few companies, and like I said, don't come out of this step with 10 companies. It must be like 3, 4 at best. That's all we need. That's the thinking process, the brainstorming, call it whatever you want. Next step is to figure out how much capital is necessary for a stock picking. So before we go any further, if you have less than $50,000, then, well, dollars, euros, whatever currency, just make an equivalent, then you don't even have to look at this video. It's pointless for you. Unless you want to know how this thing works but not doing it, then all right, fine. But the thing is, yes, it requires capital. So when we invest, the difference between speculative trading, in which we can use leverage, because basically if you do it fine, leverage can be a very profitable stuff. It's just that it's a dangerous tool, like a double-edged sword. Like if you really don't use it well, and if you do use it dangerously, then it really will come after for you, and most of the time just fuck up your capital. So yes, using leverage can help you build yourself a bigger capital if you do it well. Otherwise, all right, problems. But the thing in here is that investment is impossible with leverage. Not at all. It's not even tiny leverage is still possible. It's just no leverage of fucking all. Let me be clear in here. Investing is a buy and hold. The difference between speculative trading and investing is this is the major core difference of this thing. When we speculative trade, we always come up with a stop loss because we're using, most of the time, leveraged position, which means you're buying a CFD contract or whatever that is, but you're using leverage because your broker is basically offering you a bigger position sizing than your account sizing itself. This is the definition of leverage. You're being exposed to different markets with a global bigger positions than your account could be holding. But as we do have hedging trades, like we're buying this thing and selling this thing on the opposite times, makes it constructed in a way that normally you just can't lose everything. All right, so odds for you to be ruined, even though you're spending more money than you actually own, is fairly low, not to say close to zero. That's the goal of risk limiting, actually. All right, so the risk limitation of investment is slightly different. It's just you get in and you never get out with losses. The only way you can come up with losses is if you define that the capital might be more profitable elsewhere. How do you do this? Then first of all, you don't do it aside from the context, which means when you get to invest, you don't change your fucking mind 2 weeks afterwards. You don't change your minds 2 months afterwards. You change your minds 1 year afterwards at least. We're talking about bigger time frames in here. We're talking about weekly to monthly cycles. So if you don't even fucking wait for a monthly cycle to put itself out, then you're not even having enough feedback to do any rational decision-making process. So if you follow these stock picks each and every day and have a look at your portfolio every day, you're not really getting it right. Even if you want to have a close look at your portfolio, you're going to have a look at it once a week, and that's it. No more. And you can even say once a month is enough. All right? So the thing in here is all about timing and interesting price area. To reach those interesting weekly to monthly areas, it will take time. And if you don't take that time, and if you have a look at your charts every day, you're not going to be doing something good. You're going to be doing some type of weird mix between speculative trading and investment. And that's not something that is going to work. These are two totally different things. There are lots of similarities, and we'll get to this. But there are also a lot of differences. The first one, like I said, no fucking stop loss. When you get to buy these things, you buy with cash, you buy with no leverage, and you put no stop loss. You're just going to make somehow of a balance 1 year or 2 years afterwards when you get to interesting areas, and you're going to figure out whether this thing is going to bring up the gains later on or whether you should put the money elsewhere when there are more favorable odds for the money to show up out there. I'll explain later on, and this is most likely going to be phase 2 actually. So now that we set the ground basis, let's go one step further into actual real information. I'm sorry it's a long introduction, but I really want you guys to be into some decent basis rather than going straight forward to the actual information without proper preparation. So what's the similarity now with the things you already know? Obviously, if you haven't, if you're not even familiar with trading in general, you're going to have some troubles, because in here we do use a lot of the strategies and stuff like that that we apply onto speculative trading. And most likely in here, if you're talking about investing, you're talking about economic cycles, you're talking about growth, you're talking about investing into stocks. So we're talking about trending context more than anything else. We're going to try to profit from long-term trends that emerge from growth profits from companies and gross domestic products being risen year after year and stuff like that. That's what we're trying to profit from. So we're talking about trending context. So for the technical part, most of what we're going to be dealing with in a stock picking and investment strategy is trend trading. So why are there 3 phases? Just because there are 3 interesting buying entries in a trending trade. The first one is the reversal. It's the harshest one and the most difficult one to deal with. That's the one we're taking a dive on today. There is a step 2, which is generally the accumulation trade. And step 3 is going to be the trend pullback. All right, and obviously there are intermediate ways, like when you trade the reverse, you validate the reverse. So we get to validation areas. Let me just give you a quick example. So let's say, for example, we do a reverse trade in here, all right, a weekly trade, which means no go full hour, we got daily, all right. So let's call it that way. If this is a buy, if this is a long-term investment area, that will be the first one of a potential forthcoming cycle, which means, first of all, we need to get validation, which means we need to get to the trend channel in here, and that will be validation. When we reach validation, all right, normally afterwards, we're going to have to digest, all right, and then we're going to get to the context, all right. When we get to context, we're going to have to pull back to the trend channel. And pulling back to this trend channel, we're going to accumulate, okay, and then eventually trending again, okay. Think of it as a cycle. Don't really think of it as the price will exactly do as it said, right? It's more like we're talking about cycles, reaching out to the trend channel first, reaching out to the context channel afterwards, accumulating in here, which means starting to buy the trend channel instead of retracing to lower valuations, and starting to build high lows, and only afterwards eventually reactivating the next stages of trend, the breakout, the trend trade, whatever, all right, and then afterwards you get your pullback and your final excess, all right. I'm talking about cycles in here, but they're not appropriately meant to be onto the daily charts, all right. This is the most aggressive I've done, and remember that we said we're talking more about weekly trades more than anything else. So when I say in here we'll reverse the trend channel, all right, so the trend channel in here is going to do something like that. So within the next few weeks and years, we're going to get to this trend channel, pull back, buy the support trend channel, accumulate within the context, and eventually afterwards, all right? These are the timings we're talking about. Forget about what I said previously, okay? So when I say wait for at least a year to validate the trade, when I say what I buy right now, I'm not going to do any fucking thing until we at least bring this weekly cycle into the resistant area. That's a bare minimum to me, all right? I'm going to wait for us to reach out to the trend channel as well. Okay, so all of those things is what I'm going to be doing, and these are all the things I teach you into speculative trading anyway, so I'm not going to do it twice today. So if you don't know how to trend trade, I suggest you stop that video right now and have a look at the trend series, explaining you how to navigate trends, what are the steps of trends, how do you technically assess the probable areas for these steps to show up, because that's exactly what you do for the technical part of investing. You're going to use those trend strategies to highlight very probable areas in which those interesting timings will show up. You never know for sure. Do you really think I know the future? I don't know, but future has a structure because most of the time there is a structure to every fucking trend. And that's not because I decided it, that's just because that's how things are. It's simple as that. There is structure everywhere, even into chaos. Chaos remains chaos, whatever that is. You don't know for sure, but you risk manage, all right? That's the difference. People sometimes are investing just because they think it's an appropriate time to buy. That might be either right or wrong because they're just guessing. I'm guessing as well, but I'm also using shit tons of structures and statistical advantage to put me into a more advantageous position than these guys. I still have my personal feelings, but I just make sure they're rational. I do have technical, rational, non-subjective context that will tell me, all right, Phil, you might be into an interesting area. So let's ask ourselves the question, are we into interesting area? Yes, I think we are. We broke into weekly context. We've retraced to some interesting monthly areas. So can we do a buy and hold? Fucking yes. Is it going to be the first one of a cycle? Yes, I guess it is going to be, which means I expect 3 cycles to show up. First of all, validation, like I said, accumulation, which is going to be my second buying entry, the phase 2, and then the phase 3, which is the trend in which we should have a breakout, and then afterwards we're going to diverge because we're going to miss, we're going to lack of strength, and then we're going to pull back and final excess, and then when I'll get the final excess, I will buy the pullback, of course, and then I'll sell the shit afterwards with an intermediate profit taken in here and with an intermediate profit taken in here. I will not buy the dip, sell the top, buy the bottom, sell at the top, and buy the dip. That's what I will try to do. If I'm really, really good at my job, I'll eventually manage to do it, but the goal isn't there. The goal is just to risk fucking manage, to optimize the risk taking within those structures. So how do we do this? Like we said, how we risk manage with speculative trading is assessing the risk, therefore sizing a stop loss and allocating a % of capital to losses if we fail. That's how we risk manage into speculative trading. So how do you do this thing when you're buying and holding and you have no stop loss? Then in here, the risk management is going to be how much money do you allocate to this thing? Because we're talking about stocks. So these stocks are companies, right? They cannot worth $0 exactly, but they can fairly lose a shit ton of valuation. Like some assets will lose probably up to 80% of the prices you might be buying into them. All right, and therefore you're losing shit ton of money in there. So let's take an example in here. You're buying one stock for $1, all right, and you say, all right, this thing might be worth $50 in the future. So there is a shit ton of potential reward. Yes, that's great. But what is the underlying risk? There's probably a shit ton of risk if you're expecting 50 times multiplier. So in here, generally the risk is that this thing can lose 90% of its valuation and go to 10 cents. So if it ends up going to 10 cents, then at some point you have a simple choice. Whether you say, all right, I still believe in this thing, the company's numbers are solid, whatever, I still believe I'm going to keep on being in this thing, and you're going to keep on using the money you invested into this thing. Option number 2, you will decide that this thing is no longer a thing, you probably were wrong, and these 10 cents that remains might still be more profitable elsewhere. And in that perspective, you're going to take the fucking loss, the 90% loss, and you have to risk manage that amount, which means this 90% you lost must be reliable to the risks you took. So, like I said, you're expecting 50 fucking times, so that means you're taking high risks. Therefore, in these companies in which you can make 50 times the profits, do you really think you're going to allocate like 10% capital on this? Definitely fucking not. In those, you're most likely going to risk like 1%, 2% of your capital, which means as there is no stop loss, you're going to use pure cash and allocate 2% of your capital to this stock. So let's make a simple calculation. You've got $100,000 and you want to buy an asset for 2% risk. You're simply going to put $2,000 of asset value into this company. Pure and simply. That's how it works. And that's not fancy gorgeous buying shit tons of millions of dollars of a company or whatever. That's just boringly tiny amounts, which luckily, eventually you can multiply 30 times. And if you can luckily get those 30 times returns, then you'll be freakingly happy that you bought them for $1. All right? That's really how you should think about it. It's not how you get billionaire unless you're already pretty fucking rich. You're not going to multiply your capital by 20 or 30 times. If you do it, that means you're taking the risk of losing it in the process as well. And that's not how you invest. Investing is supposed to give you some reliable money, and this is how you will allocate your money that will make you a good stock picker, yes or no. So there are multiple profiles, obviously. You can be a risky stock picker, you can be a safer, you can be a modified intermediate profile, and I would personally teach you how to be an intermediate one, because that's what I am for my personal investment. I'm way more aggressive for my speculative portfolio than I am for investment. So let's get into it, all right? Trend trade, 3 phases. These are the technicals we do. We use the basic trend trade strategy in here to allocate, to identify the speculative areas. Now let's answer the big, real question, the difference between speculative investment and strategical long-term investment. In here, though, the difference is how much capital we allocate instead of how much risk we take with which size of positions, which size of a stop loss. But in order to avoid leveraging, which means you can say, all right, I'm buying 2% of this asset, but I could obviously in the same time take 2% of this one and 2% of this one. If you're taking 2% of telecom companies, basically, even if they are independent companies, most of them will move accordingly, which means you're not having 2% invested in a company, you're most likely having 10% invested in a single sector, which means these 10% you allocated will likely move altogether. Maybe one company will overperform, another will underperform, but that's not really how you do things. So you try to avoid taking related type of assets. All right, you're going to try to spread as much as possible to spread the risk, just like we spread the risk in speculative trading. I don't know shit about one trade. I can only tell you that I'll be profitable if I can make 100 trades. All right, that's exactly the same thing in here. If you're buying 2 companies, then, I mean, you're pretty much betting, and this is nothing close to trading, nor investing into this thing. So you need to buy multiple companies, and you need to spread it out into multiple sectors. I bet you already know this. I mean, that's just a basic way and a very logical sense for this. So buying multiple assets, now how do you do this? So the riskier you are, the more growth perspective you're going to try to go. So remember the step 0 we talked previously, just cool down for a bit and think about the future and try to come up with a few names. If you're putting a lot of money into those names, you're really going to have a very aggressive portfolio. That's not what I do, all right? So I generally pick 2-3 names, and I'm going to allocate no more than 2% capital on this, which means 6% capital on very risky assets that can give us big freaking multipliers if you get to bet on the right guy. But if you're not, then you're just going to lose a tiny portion of capital, which means the rest of the capital is either into safer assets or what I call intermediate risk profiles. So what it is, the safer assets is basically when you get phase 1, the first investment in a cycle, is generally you're going to get to very defensive sector, oversold, what we call value stocks, okay? So you're trying to project yourself out of future growth stocks, but you really pick just 3 names, no more than that. Don't go too fancy, and don't put any more than 2% capital on these assets. That would be just stupid to go any way further for a first step. We'll reinforce them into phase 2 and stuff like that. We'll talk about that later. All right, first initial investment on the growth stocks, go easy. All right, then we go safer assets. So, like I said, utilities, eventually telecommunications, and safer assets. So what type of profile are we talking about in here? Profile, sorry. So it is obviously not the Netflix, not the Amazons. All those things are potential growth stocks. Like Cisco, what is it? Yeah, Cisco might be interesting. That's more of an intermediate profile in here. General Electric, definitely a value stock. I think that's the most value stock of value stocks. So what is a value stock? It's pretty much a company that's making benefits, that hasn't too much debt. There might be a little bit of debt, but this is no big deal, all right? Just make sure that in any way, here's where you've got your things, all right? Just make sure, oh, damn it, the debt to equity ratio is enormous. So yeah, General Electric is pretty much in debt. That's a big problem. But yeah, that's probably much the most in-depth company I have. But yeah, anytime you have a debt to equity ratio above 1 means not great, all right? But that's the problem. Anyway, it means a risk, all right? So the first thing is too much debt into an asset is a risk when we're starting an economic cycle, because that's like a parking brake set it on the company. Too much debt is a big problem. That depends on what type of crisis we have. That's the reason why General Electric, I think, is still a buy right now and not too much risky. But if we get to have a a credit event within the next following days and weeks, then we're going to have a much bigger problem, okay? Because, yeah, let's cut the crap right now. We forgot about one very important step, contextualizing this thing, all right? Remember that we always follow the process, all right? We have an ID, so that was the thinking process of whichever company you think is going to be among the future and leading this future growth. Then second step is contextualizing. So not every crisis is the same crisis. You've got two types of crisis. You've got standard economical crisis like growth contraction, whatever, recessions, call it that way. That's exactly what we're experiencing right now. And you've got financial crisis. Financial crisis is coming from credits, all right? When the financial sector is failing on credit, which means some credit is not paid, therefore some money somehow vaporize. It's not exactly how this thing works, but I don't have time to get into the details in here. So depends on what type of crisis. Like 2008 was a credit event, was a financial crisis that led to economic contraction. What we have today is exactly the opposite. We do have a real economic contraction in which the financial sector is trying to not have rippling effects. So we're trying to sustain credit bubbles right now by injecting shit ton of money. So far it's working. God knows what will be in a few months from now. Can we have a credit event? Yes. Yes, of course, we do have a credit bubble, so it can burst. It wouldn't be a problem. That would be normal. But is it? So far, it isn't. So how do you react from this? Contextualizing. Did we have credit event? Yes or no? If there is a credit event, then you fly the fuck away from whichever asset has too much debt. Like obviously General Electric, you just try not to get into those type of assets because they were going to suffer a lot. Unless they provide some huge retracements, which is the case for GE. Like if you take GE out of market tops, all right, today we're at minus 90%, so it's always a risk. Like debt is a risk factor after a credit event. So you want to fly as much away from possible from these assets unless they provide very, very interesting prices. 90% discount on entries from market tops. This is something I would tend to like, even if this company is in debt. So figure out the profile of the crisis. If debt related, not too much debt into the revenue to debt ratio, okay? Just try to gather things that are close to 1, not too much above 1, okay? If there's no credit event, then you can dampen this expectation, but you need to account this as a possible forthcoming risk. But when there is no risk, all right, there's no need for huge cash, which means what you're going to be doing when you have these types of crises we're having right now is going to safer sectors, even if they are in debt. All right, this is why I think during this crisis, value stock is really interesting to gather, more than just betting on growth stocks. So value stocks must be part of portfolios right now, as long as there is no credit event. Because these are value stocks, they have been slashed in their prices, which means even if they're still come up with a risk, they're pretty much undervalued anyway, regarding the profit they make. The profit is shit ton of debt as well, which is a problem for GE, but as long as we don't have a credit event, these companies still make profits and we need them to work out, okay? So that's one way of doing it. So growth stocks, value stocks, and now what is intermediate profiles? Intermediate profiles is generally what we call cyclical activities or stuff like that, like telecommunications might be a very interesting thing, consumer staples, all of those things are like not very fancy type of growth areas, but they do provide some sustainable growth anyway, because there are sectors that never ever contracts too much. They did contract because of the economical contraction, means prices have been slashed rapidly recently, and meaning that those assets are now not necessarily heavily oversold like a value stock, but they are, yes, retraced back to average values, and some of them might be interesting. So let's take one example in here of what that may look like. Like this is one type of asset I just bought. It's a French company, telecommunication company, and basically you can see that it has been growing, not crazy fucking growing, still has been providing such a yield, all right? So like it was a 10 times yielding, so 10 times is not fancy, all right? And I'm really taking bottom to top in here. But if you take average, we would say during the last economic cycle, it has gone 2 times the average value. So it is not crazy fancy 20 times or 30 times like the apples and stuff like that, right? We're not comparing this to growth stock, but still very interesting growth in here. So it's more like an index type of growth, all right? These things are generally stock indices followers, all right? They're rarely overperforming or underperforming. They're pretty much doing the same thing, all right? So these companies have an intermediate profile, and you can really need and use them specifically into the actual context in which we seriously lack of visibility. Because the current context we have is coronavirus is having impact on the economy. That's a big fucking yes. Is it going to create a financial crisis on top of that? We don't know about it. So how do we risk manage this event? We simply allocate less capital, okay? I have personally a rule that I'm going to share in here. If the stock prices have been falling more than 50%, which means the stock indices like the S&P 500, the EUROSTOXX 600, the broad-based indices have been losing more than 50%, I'm generally going to invest myself 50 to 60% in the market and still keeping 30% cash. Like I'm going to go 2/3 in, 1/3 cash, just because cash is always necessary for an eventual crisis to go even worse, all right? You always need to have cash. You cannot be fully invested when you're trying to buy the dip. Always some cash security to be able to pay for any expenses you've had. Like, let's just say, for example, let's assume that I've been buying the SPX, or not the SPX, but I've been buying companies in here, but the future is we go there. All right, I'm still going to have to pay for my bills, okay, for an extended amount of time without making market gains. Though I do have speculative trading on top of this, which is another complex question, but let's assume that I have to pay for my bills. So I need to have cash available, because the major issue in investing is needing to sell because you've been going in too bold. So never go too bold. The first step, even if it's an aggressive one, offering minus 50 to 60% drops on equity prices, you never get fully all in. You always keep some cash. But in nowadays context, as the coronavirus is there and we not yet know if a financial crisis is down the corner, and if there is such a thing, you can be damn sure we're going to go 50% drawdowns. Then in that perspective, I'm not nearly going 2/3 in, I'm 1/3 in right now. And I keep 1/3 just for more visibility. So eventually, if we stay there for the next few months, and if there is no credit event, I'll probably invest that second third into the nearby area. Otherwise, I simply wait. And if we do have a credit event, I'm going to buy in with that second third into far lower valuations, probably at least close to 50% drawdowns. Okay? So that is how you risk manage, because the only way you risk manage in an investment portfolio is just how much money you put in. Because as it's in, it can't go out unless you get to terminate a bullish cycle. Okay? So that's how you need to understand these things. That's the context difference between speculative trading and investment trading. The technical strategy, pretty much the same signals, the same areas, the same way of thinking, just on a broader picture scenario. Okay? And last but not least, how do you risk manage in position? Okay? So it depends on which asset profile you've been buying. So the growth assets, like I said, the Teslas, the Virgin Galactic type of things, I don't want these assets to surge. If they surge too soon, that means it's a very bad sign. So let me explain what that is, all right? When you buy a growth stock, I just been buying this thing at the lowest price for now. We don't know for sure, all right? Remember that I'm not playing God. Remember that I missed the goddamn fucking Tesla in here. My goal was to buy in here, and we just gone right before already my entry prices and surged. So I decided to buy in here afterwards. So I'm in. I wish I could have been in there, but I didn't. So at least I'm in here. So if Tesla is doing something like that within the next few weeks and months, I'm not going to keep this thing. I'm probably going to sell it at interesting prices and not going to stay there. What I'd like for Tesla in the forthcoming weeks and months is something like that. Okay, if the asset is doing such a thing, then I got them like it. I don't want this to bring shit tons of gains in the early stages of the economic cycle. Normally the growth stocks are pretty boring into the early stages of an economic cycle. They accumulate, they volatility contract, they build higher low, and then they break out and they fucking trend. And this is where they provide much of the gains. So how do you manage this thing? You get in with tiny portions of capital, you wait and see how does this thing react within the next following weeks and months, and you somehow make a review of it 1 year from now. So 1 year from now, I'm going to study how prices behave for Tesla. Anytime we get to a resistance, I'm selling. Remember that Tesla, I bought in, got out. Not out, but I take some profits. All right, and then I'll get in again as we'll work out more supports, and I'll profit take and get in and profit take and get in and profit take. Always tiny portions. I get in, I take 25% out. I reinvest those 25%, which means my position sizing is slowly increasing. But I'm always respecting timing. Remember that. I'm not going to blindly buy and sell. I'm going to respect the range strategy, probably out of daily or weekly context charts. Okay? I'm going to apply my rules. I'm not going blindly in here. I'm going to range trade these assets. Generally, they range trade, and then accumulation shows up. We start buying the trend channels instead of buying the contexts, and in that perspective, generally, then the trend can emerge from this. And this is where you get the breakout trade, right? Reinforce the position sizing, put more money into these assets, and let the trend ride, right? So that's how you risk manage investment for growth stocks, okay? Now, how do you go for safer assets, like the value stocks? The value stocks is not something you hold for the entire economic cycle. Remember, let's take a 5 to 10 year economic cycle with a 3 global cycle. Remember that there's the first range building, type of pullback accumulation, trend trade, pullback, and final excess, all right? Just that's not what I forecast for General Electric or eventually, but this is not what I care. I do care about those growth stocks on a very specific type of portion of the economic cycle, just this one. So I'm not buying value stocks for this. This might be interesting, this might be providing some yieldings, but I don't care. At that stage, the money I have is much more profitable elsewhere. So the value stocks, I take them for the early stages because they can provide quite some very interesting and solid gains without too much risk. But afterwards, they will provide far less gains, which means I can go elsewhere when the money will be far better used. So this is where you trade growth stocks, and then you trade value stocks, and then you really underperform them, underweight them into capital, but you still keep them, or you just get the hell out. All right. So we'll talk about this in phase 2. So basically, it's buying in here, always in weekly context. So when I say this area is an area of interest on General Electric, it fucking is. So buying in here makes sense. We're not buying out of nowhere. Remember that. You don't buy because you think it's the dip. You buy because you have technical, rational information suggesting this area is an area of interest. So buying in here, very interesting. What do I target? Same old thing. I'm targeting the validation, which is this thing. At least getting to the trend channel, so that will be validation, but normally these stocks are rapidly retracing toward Fibonacci. So in here, what we do is that we trade the building of a range that's generally retracing the bear trend, and we're generally targeting the Fibonacci ratios. So I know that my first profit taking is going to be when I will get to the trend channel and possibly as close as possible to the 23%. That is going to be a taking profit number 1 in this area. Let me just change the colors. All right, so that will be a taking profit number 1 for me in here. Profit taking number 2 is going to be when we reach out to moving averages. Never hold a value stock on top of moving average pricing. I'm not talking about short-term moving average. This is a 50 moving average coming from quarterly base. So this is a 50 quarter moving average. Okay, this is a very long-term thing. So when we get to this thing, any fucking way, I'll be out. Luckily, I hope we'll be testing the 38%, which is my maximum target for this asset. I'm not targeting anything higher than that. All right? So don't get me wrong. Value stocks is for retracement purpose only. Anytime you get to a retracement level, get the fucking profits. Not necessarily entirely, but in here is in mandatory 25 to 50% profit taking. And in here, you just get the fuck out. Okay? If you want to keep this thing in portfolio, you can keep like 25% after this stage, and you can eventually buy yourself in afterwards. Okay? That's how you risk manage with this with the value stocks. And now for the intermediate profiles, the typical way of reacting is this is where you get to buy. All right, this is where you get the taking profit. As you can see in here, we're getting validation already. All right, so this one has been going real fast. This is exactly what I want. Normally, these assets are the ones that are going to trend the fastest, even before the growth stocks. Right? You might be saying, all right, this is the future. This is where we should make shit tons of early gains. No, this is not. Think it's actually quite the opposite. Normally, the ones that will provide the biggest gains during the economic cycle are the ones that lags the most. The cyclical activity, reliable activity that sustained the crisis but still dropped prices fairly significantly are the ones that will generally provide much of the early gains on the economic cycle. Because these ones will not just create pullbacks, these ones will retrace the fucking downtrend. All right? Though remember that on these assets, we target the Fibonacci retracement, 23, 38, generally no more than that. On these intermediate assets, we're already 38% retracement. I'm not targeting any such a thing. I'm targeting way more than that. Normally, these things retrace 61 to 76. This is where I sell these assets. When I say sell, I'm saying profit taking. All right. So this is my target area for the first part of this trade, and then I'm going to buy the pullbacks and keep those ones for trends. Okay. That's how things works. We're talking about the first stage in here. So the first stage is in this, guys, no more than 23%, 38% retracement, and lock on the gains. Don't let too much of those positions open. They generally retrace a lot. Then you've got these guys as well. Don't fucking forget to profit take in here, and that's a mandatory 50% profit taking in here to reinvest this money later with a premium. Okay? The goal in here is just to make an easy trade, take some nice money. All right, that's a 2 times entry. You get into 90 and you profit taking at 180. So that's fine. You're putting 3% in terms of capital, 2 to 3% in. You take slightly more exposition than you would do for the growth stocks. Though 2-3% maximum on these types of assets. Just take multiple of these, all right? No more than 3% into one asset. Just take other assets if you want to. Other telecommunications, don't too much, all right? Just take 2 companies, for example. Or go into other sectors. Like you want other sectors, like energy would be these types of sectors that can provide such an intermediate profile. So just have a look at how prices have been working. Okay, remember that intermediate profiles are the one that trend follow the economic cycle and consolidate hard and provide deep retracement. Though you can get into buying those things. The safer assets, the value stocks are stocks that have been slashed in valuation. They've been losing 80% at least, though you're most likely buying the value of those assets more than the price, okay? And the growth stocks is just the things you think are going to be among the future, and they generally provide shit ton of volatility on the early stages of the crashing market, okay? And you risk manage accordingly. On the riskier assets, on the value, just retracement. On this one, you target Fibonacci retracement of the bearish consolidation, no more than that. You're not targeting new highs. That's not going to happen anytime soon. You target 61%, you first profit take. If you're really lucky, you can get up to 76, and that's a mandatory. If you get 76, just fucking profit take without even questioning, right? It's just, this is the area in which you look for profit taking signal, starting at 61, ending at 76 with mandatory 76 profit taking. Okay, then you let the asset consolidate. Generally, most of the time, it would just dry out in the dump zone. All right, that's generally how this thing happens. And after a little while, you're gonna buy the accumulation trade and hope for this asset to break up. Sorry about the cat. So that's how these things are managed. We'll explain a little bit more about the accumulation phase when we'll get closer to phase 2. So there will be 3 parts of this podcast. The other 2 ones will show up later in time when the appropriate time will come. Okay, so that's going to be it for today. Just to sum up the core informations, once again, just mostly warnings about the possible mistakes that can be done in here. The biggest mistake not to make, never even try to build some kind of a bridge between investment and speculative trading. These things are absolutely going to be separated because you need capital on the second one, and you simply cannot use leverage. On the first one, you can use leverage if you do it properly, which means you need to be taught how to do it. You need to have a strategy, you need to have a rational way of risk managing, and that takes years to be learned. So that's how it goes. It's far easier actually to invest than it is to speculative trade, but it requires a lot more capital. All right, pros and cons, and it requires knowledge anyway. All right, the speculative knowledge is absolutely necessary when you get to invest as well. The other problem that comes up with investment is that can look like easy gains. You can make 2 times, 3 times, or even up to 20 or 50 times multipliers for the actual growth stocks when you actually manage to pick the right candidates, which is not going to be easy. And yeah, that can sound like, oh man, I could be a billionaire. Then just be rational. We're not talking about anything close to this, because when you're talking about the big names, 20, 30, eventually 40 times in the initial investment, that means that you invested a very tiny portion of the capital in the early stages. Remember that we were talking about 1-2% at best. So making 40 times 2% still is great, but certainly not going to make you a billionaire. Right? Of course, that depends if you already are a billionaire or half a billionaire at the beginning of the economic cycle, all right? But don't get me wrong, you're not going to multiply and apply huge multipliers to your capital, right? We're talking about in here some assets making shit tons of multipliers, some other making less fancy multipliers, and what we're talking here is about average yielding of the portfolio, all right? So no dreams, no stupid things like that, no Lambo to the moon fucking type of things like that. Let it to the dump. So risk manage is absolutely key. Don't blind trade. You don't trade because you think the context is appropriate. You make sure that technically speaking you're into an area of interest. The first phase always show up to at least 30% drawdown from market top. It doesn't show up with -10, all right? It's really minus 30% at least. The first speculative area is generally between 30 and 40. That's exactly the one we're experiencing right now. And if there is a credit event, we generally go 50 to 67, all right? To 66, all right? Well, it's a 2/3 of valuation loss. So if we do have a credit event triggering within the forthcoming months, we will drop prices seriously lower. That's the reason why you need to be prepared for it. How do you prepare? That doesn't prevent you from buying right now. You can't put a stop loss, and you have to buy less and keep some cash just in case, and wait for more visibility within the next few months to decide if whether or not the credit risk is dampening enough for us to invest more and invest the remaining 1/3. Okay? That's the core element, rule number 2. The third is how you're going to be able to psychologically manage these things. We're talking about weekly to monthly trades, so the biggest mistake in here is to follow the fucking portfolio on a day-to-day basis. Don't do it. Just be rational. Once a week is more than enough. It's even a little bit too much. Wait for weekly cycles to terminate. All right, so have a look at weekly charts, have a look at this fucking sine wave, and when sine wave is in the bottom, means you're into an interesting buying area. When sine wave is in here, means you're an interesting profit taking area. Okay, that's as simple as that. If you're a little bit more aggressive, like I said, if you want to range trade the growth stocks, then you might eventually follow daily cycles, but still that will be way more aggressive. Okay, way more aggressive means more risk taking, means if you do it well, that should bring some gains. If you're not doing it well because you're not experienced enough, you're likely going to bring some losses, okay, or bad decision making processes. So don't do it. All right, no leverage, be rational, be patient, organize your capital, organize your risk. Don't be a stupid asshole thinking you're going to multiply your money and be rich tomorrow. That's not how it works. You're just going to profit from the growth that the economy is providing, okay? Try to make your own choices. Don't fucking pick exactly the same assets as I did. That would be just stupid. Take the educational content in there. Just don't go blindly copy trading me, okay? I think that's it for today. So thank you guys for attending. I'm sorry it was a little bit messy. I wish I could have made a plan before going into this ones, but you know I'm not preparing those podcasts. I'm basically just starting it, opening the microphone, talking for an hour, just trying to share the knowledge. There are some pros and cons of doing this. Obviously, that means it is more of a spontaneous behavior and stuff like that. I know some of you guys do like that. The opposite con is that obviously sometimes it can lack of structure and stuff like that. But I think anyway that I'm doing my best for the information spread out in this to be as valuable as possible. So anyway, I hope you liked it. We'll see each other again later for some other podcasts, and this part 2 will show up far later in time, probably 1 year or 1.5 years from now. See you guys later.